Hello and welcome to Module 5, Week 1, Project Revenues and Costs. As mentioned in the introductory video, financial planning is important to evaluate the financial viability of your RRR business. It will help you to take better decisions and convince financial partners to invest in your business. We will do a lot of Excel tables together, so bear with me, it is crucial for your success. In the last module, you decided which resources you need to launch and operate your business. You calculated how much land you need, you chose your technology, and you set up a staffing plan. This week, you are going to calculate the cost associated with acquiring these resources and the costs for running your business. So basically, what we will do is to create a detailed version of the cost structure from your business model canvas. You will also do a projection of your annual sales volume and revenues. This is nothing else than a detailed version of your revenue streams from your canvas. By the end of this week, you will have an estimate of the investments you will need to launch your business and of the profit or losses you can anticipate over the next few years. So, let's start with the investment costs. Investment costs usually occur at the beginning of the project and include things such as the purchase of land, machinery, equipment, or construction costs. You will find two worksheets below, one Excel version and one PDF version. Choose what you want depending on whether you prefer calculating your costs on the computer or by hand on paper. Let me show you how to calculate your investment costs in the tab Investment Costs. In column A, you have the description of your investments. These are the physical resources you need before you can start with your actual production. The first part lists the land and buildings that you have determined in week 4 of module 4. Write down in the next column how many buildings and square meters of land you will need. Once you have done that, note down the costs of acquiring these in the third column. If you work with Excel, the total investments in the fourth column is calculated by itself. Let me show you an example for a composting plant with a capacity of 12,000 tons of compost a year. Here in this table, these people have calculated that they need 3 roofed treatment units for 70,000 each. In addition to that, they also need an office as well as sanitary facilities for 50,000 each. The second part lists all the machinery and equipment that you have determined in week 3 of module 4. List down all the machines and equipment you need here. Not only for the pre-treatment, the treatment and the value addition, but also for transport, storage and any other support activities. Just like above, determine now how many machines and equipment you will need in column B, as well as the costs of them in column C. The total is again calculated automatically in column D. If we use the example of the composting plant again, these people here need 2 waste collection trucks, 2 excavators, 2 shredders, a sieve, a conveyor belt, a laboratory tool, and so on and so on. Please do it the same way for your case. When you start up a business, you have additional one-off expenses. We call these expenses startup expenses because you only have to pay them once when you actually start up. This may, for example, include paying an engineer to design and supervise the construction, get all kinds of licenses, legal fees, or maybe you also want to employ a web designer to create a website. List all these expenses in the bottom part and calculate again the totals. If we look at our example again, the composting plant has to invest into engineering services, get the operating license, pay a lawyer too much money to get the procurement contracts set up, and finally, they also have to pay the state laboratory to get the necessary compost certificates. Once you have listed all of the infrastructure, land, machinery, equipment, as well as the startup expenses, you will get your total investment costs at the bottom here. In our case of the composting plant, the total investment costs are 436,000. Let's now look at your revenues. Revenues are the income that you make from selling your product or service. Technically, this is a very simple calculation. Basically, what you do is you multiply your selling price of your product with your annual sales volume. You should already know both your selling price from module 3 and the estimated annual sales volume from module number 2. Let us look at the concrete figures now. Again, I will use the example of the composting plant so I can walk you through the actual calculation. In your worksheet, you will find another tab called Profit and Loss Statement. At the top part of this table, you will see the heading Revenues. That's where we will be working now. As a first step, you have to estimate your annual sales volume based on how many products you think you can sell or how much you think you can produce. In our case of the composting plant, it is expected that they will not operate at full capacity until year 8. Now, why is this the case? On one hand, it will take them time to get the product into retail shops. On the other hand, training new staff members operating the plant always takes up time that is consequently lost in producing the compost. And since we assume that the staff fluctuation is very high in the local area, it will actually take the management several years until everything runs smoothly. So as a result, instead of producing at full capacity in the first year, which would be 12,000 tons of compost, they only produce 20%. This results in 2,400 tons of compost, which is way less than they actually could. Let's go back to your own calculation. You should have calculated the capacity of your treatment plant in the last module. Insert this figure here for your product. Whatever it may be, maybe it's compost in tons or cubic meters of irrigation water, bags of briquettes, or whatever you're actually producing. If you're actually selling more than 2 different products or services, add additional lines and then you can add up your revenues. Once you have estimated your operating capacity and sales volume for the next 10 years, multiply that with your selling price to get your total revenues. In our example, again from the composting plant, they sell their compost for 55 per ton. Multiplied with the tons of compost they produce in the first year, the composting plant will have revenues of 132,000 in its first year of operation. So, are you still with me? Let's move on to the other side, to the costs now. We will start with the operating costs. These are the costs for operating and maintaining your business. Remember, in the last modules, we have discussed that operation is not just about the technical production process itself, but that there is much more to it and a lot of support activities like marketing and sales, human resources, financial management, and other things really eat up a lot of cash, and that's why we need to make sure that it will not be too high. Now, if we go into details, we can divide operating costs in 3 parts. 1, the cost of raw materials. 2, of fixed costs. And 3, of variable costs. The cost of the first one, the raw material, is the easiest. If you have done proper market research, you should have a fairly good idea on how much you will have to pay for your raw material, for example, compost. More complicated than the cost of raw material are the fixed costs. Fixed costs occur irrespective of the production volume. So whether you produce 1 briquette or 1,000 briquettes, the fixed costs always stay the same. These costs will really cause a lot of headaches, so try to keep them as low as possible. Typical examples of fixed costs are, for example, the salaries of your fixed staff, for example, yourself, or interest payments or loans, insurances, depreciation costs, renting special machines or renting cars and vehicles, or costs for promotion material. The last one out of the 3 operating costs are the variable costs. Variable costs change with the production volumes. The more you produce, the more variable costs you will have. In our case of RRR businesses, these are typically, for example, the salaries of your temporary staff you have, so your helpers. The more you produce, the more people you will employ. The same applies to, for example, electricity, water, or fuel, because the more you produce, the more you will need of that. Furthermore, for example, also the maintenance of your machines and vehicles are variable, and also the packaging of your product and delivery costs of your products are usually variable. And last but not least, also other consumables like gloves for your staff or other protective gear is variable because you will need to buy more of those the more people you are using to run your business. Now let's go back to the worksheet. In the same tab, Profit and Loss Statement, below the revenue part, you will find the description of your different costs in column A. Like I just explained, these are split into the costs of the raw material, your fixed costs, as well as your variable costs. Let me explain the table by using the example of the composting plant again. The cost of raw material refers to the price the plant has to pay its suppliers per ton of organic waste. In our case, 1 ton of organic waste costs 20. Now, the tricky part is that you do not get out 1 ton of compost out of 1 ton of raw material. In the case of compost, the mass reduction is approximately 50%. So to produce 12,000 tons of compost per year, the plant needs to process double the amount in organic waste. So we end up with 24,000 tons. Since the plant is not operating at full capacity in the first few years, the cost for raw material is also not too high at the beginning. In our example here, in the first year, the costs for the raw material is only 96,000. But you can see, as the plant increases its capacity in the following years to 50%, 90%, and eventually to 100%, the costs of the raw material proportionally increases as well. Now let's look at the fixed costs. As said before, fixed costs are independent of your operating capacity. So irrespective whether you produce something or not, you will always have these costs. In our case of the composting plant, they employ 3 fixed staff members that earn 9,600 each per year. That makes a total of 28,800 per year for the salaries alone. Adding to that, our composting plant also needs to rent some equipment at a fixed annual rate, and they spend fixed amounts on things like promotion, office communication, insurances, and trainings every year. So far for the revenues and operating costs. Now we have everything together, so you can already calculate your gross profit or gross loss and your operating profit or loss. If you look at the table, your gross profit here is in row 17. The gross profit equals to the total revenue minus the total costs of raw material. If your gross profit is actually a loss, so you're actually in the minus, then your selling price is definitively way too low. The operating profit you will find in row 37. The operating profit equals to the gross profit minus the total operating costs. If your operating profit is not a profit but a loss, then you are either not operating efficiently enough or you don't sell enough of your products. Now that you have calculated your operating profit, you might wonder why the investment costs haven't been deducted yet. This is because in the profit and loss statement, investment costs are not deducted, or at least not directly. However, indirectly they are there through the position we call depreciation. When you invest into physical resources like buildings, machinery, or equipment, they will eventually need to be renovated or replaced. So in short, they have a limited lifetime. So depreciation essentially is the money you put aside to finance that renovation or replacement at the end of the car's or building's lifetime. However, depreciation is only a calculatory value because you're not really putting that money on the side, but only calculate it for your financials. But we will look at that closer next week. Depending on the resources, this lifetime can be 30 years, 10 years, or maybe just 3 years. You will need to check with your national tax laws to be sure to assign the right lifetime to your resources. To be able to calculate the total annual depreciation of your assets, which is just another word for physical resources, please go back to the worksheet and the investment cost tab. If you open the table, you can see here that the last 2 columns are for noting the lifetime of each asset and calculating the depreciation of each asset. In its simplest form, depreciation is therefore just the calculation of investment cost divided by the lifetime. In the case of our example of the composting plant, the lifetime varies between the assets. For example, it is 20 years for the treatment units, 10 years for heavy trucks and excavators, and only 5 years for the equipment like shredders and sieves and so on. Calculated like that, the total depreciation that the composting plant has to deduct in its profit and loss statement every year is 33,000. So, going back to the profit and loss statement, you can see that by deducting the depreciation, the composting plant is expected to make a loss, not only in the first year, but in all the consecutive following years as well. After deducting the interest the plant pays on a bank loan, the net loss of the composting plant is even higher. Just from looking at the net loss, you might say that this business is not financially viable. Now, this is not something that is uncommon, especially for composting plants. They are very resource intensive, which drives up the operating costs, and when competing with the subsidized price of chemical fertilizer, they cannot sell their compost at the cost-covering price. The required investments into infrastructure are also quite high, so that only plants with very high operating capacities can actually break even. The Kerevalapitiya compost plant in Sri Lanka that processes the organic waste of the capital Colombo is such a plant. The plant treats 500 tons of organic waste per day and produces 50 tons of compost a day. Although they are only just breaking even with their current selling price, they are planning to increase their selling price by enriching the compost and make net profits. But don't worry, you don't need to start straight away with treating the organic waste of a whole megacity. There are ways to get around this. We will look at possibilities for recovering operational costs with alternative revenue streams in week number 3. But before that, forecast the profit and loss statement for your own business and then head over to week 2 to learn about cash flow planning.